An important market voice, Andrew Holland, CEO at Avendus Capital Alternate Strategies, joins us right on our show. Andrew, good having you. Thanks so much for joining in. Neeraj here, good morning. You guys turned bullish at a very opportune time. Since then, the markets have given some very interesting, very decent returns. Do you continue to stay optimistic, Andrew, on the Indian bourses?
I do actually. I think there's a number of reasons behind that. One is that the earnings season wasn't so bad. Obviously, we're going to see if there's any follow through from the kind of the spending over the festival period. But the good news is that a lot of those auto companies, should I say, have managed to reduce the inventory. So things are looking a little better there. I still think that interest rates are going to fall in India, so that again is a tailwind for spending going forward. But I think the final piece of the jigsaw we're still awaiting for, which is obviously tax cuts for the individual, for individuals to get the economy really going. If I add all of that and then plus the global tailwinds of a US-China trade deal, I'm not sure if it's going to be a trade deal or a kind of a reduction in or removal of tariffs going forward, and then obviously you have the kind of the Brexit problem being again kicked down the road till the end of January. So a lot of the kind of global kind of headwinds which were there or worries have moved away. All of this kind of leads me to think that the US dollar will probably weaken from here. So what I think you're going to see is more money go towards emerging markets. One, because obviously a lot of emerging markets will be beneficials of the US-China trade, kind of tensions going down, and obviously because the dollar will weaken. So we'll get, our flows, because of our weightage, will get dragged up along with the rest of the world. So I think in the next, in the very short term between now and the end of the year, that the Nifty could easily get to around 12,500.
Mm-hmm. Okay, Andrew, the consensus was, and probably in some extent still remains, that the quality names do well. Just that the last 2 odd weeks, we're seeing this up move becoming a lot more broad-based. Do you reckon that will be a sign of things to come? The Nifty may do whatever 12,500 or whatever it is that it does, but the broader markets will see a far greater uptick because of the depressed nature that we've seen them going through in the last few years?
I think initially it'll be selective because we're not out of the woods. It's not as though the corporate tax cuts will have such a positive impact to move the economy. So we still need those tax cuts for individuals, but for certain sectors and certain companies in the broader market, I think you will start to see good outperformance. The broader market, below the stocks which move the index, is looking more attractive. But I think for the broad market to move up as a whole, you'll still need to see evidence, or the market want to see some evidence that the economy is recovering, because these companies are all obviously operationally geared to the domestic economy. So we might be kind of 1 quarter away from the broader market really taking off.
Keeping up at that point, Andrew, while much of the conversation when we saw a lot of value depletion in the mid caps and the small caps came about to the fact that should not paint every company with the same brush within the mid-cap space. Similar, would you think is the case when things start to improve in the mid-cap space, and it is not just everything that will start moving up together, but just those quality businesses that have managed to stand the test of time, or probably gone through this period and come out shining, and that's the area you need to focus on?
Exactly. I think you've said it exactly the way I was thinking, is that it's going to be selective at the beginning, because you want to get to those companies which have either cut costs, improve their efficiencies, and they'll be the beneficiaries as the economy turns up. So they will be the first ones that people will rush to buy, and then the broader market will just get lifted up along with the market as the economy starts to improve. So that's what I'm thinking. So you articulated it very well.
So far, Andrew, how have the earnings shaped up for you? I mean, what does this do for the yearly forecast for earnings?
So I think, the tax cut actually kind of gave a bottom to the kind of earnings downgrade that we've been seeing. I mean, there'll be certain companies, obviously we still see some downgrades, particularly in kind of, say, the pharma sector. But overall, I think the results from the large companies have been there or thereabouts, if not a surprise on the upside. So I think, maybe we got too pessimistic, in the kind of September period and early October, and then the results have been a lot more kind of buoyant than I think most analysts were expecting. So therefore, it's a nice backdrop as the economy improves to see, once we haven't seen for a long time, is to see earnings upgrades, and I think that will happen probably in the first quarter of 2020.
And I just want to get your, how do you view a situation where someone has identified a stock which has probably run up 50-60% in the last 1 year? I'm talking purely from the broader market spectrum, the smaller to mid-cap names. Stocks have run up, the growth potential is there, valuations have suddenly become too steep in the last 1 year, but these are value accretive businesses. So should one stop themselves from investing currently because of the fact that they've run up 50-60% in this 1 year, or the fact that they focus on the future and see growth accretion happening, and therefore in the long run, if you take a slightly more wider look at the price graph, this may not be a bad entry point?
It depends on the company that you're thinking about or thinking of investing, because if you look at, say, the QIP of Bajaj Finserv, I mean, it's been very heavily oversubscribed. Now you could say the valuations are very rich too, but as we kind of hurtle towards a $5 trillion economy, then where will Bajaj Finserv be in that environment? I'm sure it'll be a lot larger, and given this replenishment of its balance sheet to continue its growth, the ratings will continue to remain high, and the growth will remain high as well. So, it depends on which company and which sector, but I would say that stick to the quality at the moment. That's where you're going to get the returns over the next 1 year. But increasingly, look towards the quality kind of mid and small cap names, and then as a broader market moves, you can actually kind of dip down a lot more as the economy improves into 2020. So that's the kind of strategy I would be looking at.
Andrew, just one final question, and that is, how do you pin the world and what's happening there vis-a-vis what could happen in India? For the sentiment to stay positive, the globe needs to do well for flows and for sentiment. RCEP, not a big market moving event, but has happened. The trade war seems to be reaching some bit of positivity. Is the globe set up for us as well, or could there be challenges there?
There's always going to be challenges. I mean, we still have to see the finer details of any agreement between the US and China and how the market reacts to that. And really, what's said about phase two, if there is a phase two. One of the things I do want to point out here is that, for US and China to have a trade deal, it still has to be passed by Congress, and that certainly won't be happening before there's a new president in the White House. And as we go into next year, you're going to be thoughts about whether Elizabeth Warren will have a good chance of becoming the new president of the US, and she obviously has a lot of noise around the kind of tax increases she would want, and that's something that Wall Street would not want. And of course, you've got the impeachment of President Trump, which again is gathering speed. So, we're certainly not out of the woods, and that's why I think you're going to get a weaker dollar, which will be good for emerging markets. So that's the kind of shorter term. But going into next year, I think worries will persist. I'll give you one example. There's two leading brokers in the US. One is saying that the US could go to negative interest rates because they have a more negative view on the US economy, and one is saying the US interest rates could go to 2.5% to 3%. So there's a dichotomy in terms of views, and that obviously will bring you more volatility as well.
Okay, Andrew, we'll leave it at that. Pleasure having you today. Thanks so much for taking the time out, and best wishes for the new year.
Okay. Thank you.